My piece over the weekend was referencing the World Bank's Africa Pulse report, in which they said the road ahead is bumpy. Economic growth in sub-Saharan Africa is estimated to have picked up to 2.7% in 2018 from 2.3% in 2017. This is the key point, barely above population growth. The region's economic recovery continues, but at a slower pace than expected, 0.4 percentage points lower than the April forecast, due to a downward growth revisions in the three largest economies in the region. The road ahead is bumpy. Of course, the three biggest economies, South Africa, Nigeria, and Angola, make up 50% of sub-Saharan African GDP, weighed on economic activity. And I found this data point interesting. Countries with economic performance that lost steam in 2015 to 2018 relative to 1995 to 2008 represent about 1/3 of the region's population and nearly 60% of its economic activity. Their median rate of GDP growth decelerated from 5.4% in that 95-08 period to 1.2% 2015 to 2018. This group includes the three largest countries in the region, Nigeria, South Africa, and Angola, and has an average GDP per capita of $2,696. Half of sub-Saharan Africa, from Buhari to Lourenço to Ramaphosa, is firing blanks, and all are looking around for a silver bullet. Growth in the rest of the region was broadly steady, but performance varied across countries. Economic activity remained solid in the fast-growing, non-resource-rich countries such as Côte d'Ivoire, Kenya, Rwanda, supported by agricultural production and services on the production side, and household consumption and public investment on the demand side. A sub-Saharan African economist has also got to be an accomplished meteorologist, because rains have an outsized effect on GDP and well-being. Good rains have underpinned GDP in this part of Africa and topped it. During 2012 to 2017, government debt is estimated to have increased by more than 20 percentage points in the region. Debt rose in about 2/5 of the countries in 2017 and was above 60% of GDP in 1/3 of the countries. Clearly, even the latest fashion of supersizing one's GDP, a la Ghana and Zimbabwe, the debt trajectory is not sustainable. At the end of 2017, 8 countries, Chad, Eritrea, Mozambique, Republic of Congo, Somalia, South Sudan, Sudan, and Zimbabwe, were classified as in debt distress under the World Bank IMF debt sustainability framework. Additionally, the previous moderate ratings for the Gambia, Zambia, and Ethiopia more recently were changed to high risk of debt distress. What we know is the dominoes are set to fall. One domino that has suddenly tipped over is Zimbabwe. Reuters reported that people again formed long queues to fill up their cars in the capital, with others panic buying basic goods like cooking oil and sugar. There are $9.3 billion of zollars in the banks compared to $200 million in reserves, official data showed. A mismatch that creates a premium for the US dollar and fans the black market. On the black market, the premium for the US dollar spiked to a new record on Saturday, reaching 165% from 120% on Monday, traders said. That means buying $100 in cash via a bank transfer cost $265, up from $220 earlier this week. The government's voodoo economics, where it spent $1.3 billion pump priming the economy ahead of the election, money it did not have, was the straw that broke the camel's back.